Welcome back. I've been discussing with an elite panel of bankers and the economist from HSBC on what they make of the monetary policy and what might be the impact. Now, one of the standout statements from the governor was that he would do anything for financial stability. And what was absent was a much-awaited package, perhaps, for NBFCs. Mr. Basu, first to you, do you think that we are going to see a second wave of bad loans from the NBFC housing finance sector?
So on the NBFC sector, we have been dealing with this now almost for 7-8 months. And what we observe is that we should not be clubbing the whole sector all together. There are some very good NBFCs who've held out, who have not only managed their liquidity, they have also managed to grow their book as well. And we know the names, and some of them are very large companies. Some smaller NBFCs have also done reasonably well. We also know the names of one or two companies which have come into difficulty. And as people would be aware by now, it is just not a liquidity issue. It is an issue of having the asset liability mismatch being corrected. If there is a under solvency and issues like that, those need to be corrected. It has to be something which goes on over a period of time. I think so far all the players, including the creditors, the lenders, the Reserve Bank, the government and the regulators, they have all done it in a calibrated manner.
Okay.
I think that is how the way should be. Even RBI has indicated that they would like to control the sector, but they would like to do it in a calibrated manner. I think that is the answer.
Let me ask the economist, since she would perhaps look at it in a more objective manner. Do you see dislocation in the market and therefore in the economy, Pranjul? Or do you think it will be something which the market can tide over without any specific asset purchase help or something like that?
Well, look, growth is slowing. But I think it's slowing for reasons which are just beyond what's happening in the financial markets. I think one of the reasons growth is slowing is because it always slows in the quarter before national elections, because there's a lot of uncertainty, nobody spends, nobody does investment, the government has generally run out of money by then. And I think we're sort of clubbing it all together, the pre-election stress along with, the NBFC stress, and we're calling it one big thing and we're attributing the whole thing to NBFC. I think that's not fair. I think it's important to sort of differentiate. And I think we'll only be able to see this differentiation in the second half of 2019. When political uncertainty would have completely gone, it would be a fresh quarter, a fresh second half of the year, where private capex, replacement capex can actually come up. And then we'll see what the real problem created by the financial sector mess was. I think it's very hard to get a call now. Our own sense is that growth, which is about 6% now, in the second half of the year will go up to about 7%. And that's where potential of India is. Whenever we are at 7%, our inflation is in a good range, it's sustainable.
So
whenever
Pranjul,
we are more than 7, it's unsustainable.
Pranjul,
inflation rises.
Pranjul, you're not buying 7.5 for the last quarter of FY20. That's the RBI's forecast.
Well, look, I would buy it because of statistical reasons, just because it's a very low base, and therefore statistically it'll be bumped up. Right. Yes, but once the base effects go, then I think we'll be resting at about 7%.
Okay. Well, Prasanna, what's your sense? Do you think that you're going to expect some robustness in credit offtake? What are you smelling? Cost of capital goes down, confidence returns. Is second half going to be finally the time when growth will fire?
So I think, Latha, we also have a very, very similar trajectory of growth like what Pranjul was explaining, except that our confidence level in the second half growth picking up is possibly also relying on the fact that the government is also going to unleash a set of reforms starting with the budget next month. And they have pretty much, it's a continuation of the earlier government, so you have a lot of existing policies that they've already half implemented, which they can actually go ahead and implement and also come out with new measures. So we do believe that monetary policy is only one part of the heavy lifting that is needed to pick up to make the growth return back to normalcy. This particular rate cut alone might not be enough. We would want a very dovish RBI to continue. Plus, we would want a slew of reforms to come from the government side, not only on the NBFC sector, but also on the regular auto sector, as well as all the other, the capex, the private investments, so on and so forth, for it to really pick up in the second half. So we do have a sanguine view on the GDP growth on the second half, but maybe slightly lower than what RBI's estimate is.
Oh yes, and you would also not want the global growth to collapse, and you would not want tariff wars and that kind of uncertainty as well. Yes, some things are beyond us. You know, I want to end with a technical question, and Rajiv is eminently placed because he was formerly a money markets guy as well. What did you make of this comprehensive review of money market directions that the Reserve Bank has announced, Rajiv? You know, they want to look at call money, repo, commercial paper, all other paper under 1 year, and you know, rationalize existing regulations. What should we make of this?
So I think it's, I don't think there's any conspiracy theory here.
No. I'm asking you to explain.
The way I see it, I think all they're trying to do is define money market, you know, in terms of all these instruments. If you look at the regulations, you know, it's quite disparate. So they just put it together so that, you know, when they talk about money market instruments, all of us are very clear on what they actually mean. At least that's what I read, you know, from that particular regulation, that it's just a question of rationalization of the definition of money market instruments.
Okay, 10 seconds for you only, Rajiv. Do you think that the time will come for RBI to give some special help to NBFCs, HFCs or mutual funds? Or do you think with entity level jitters we will pass?
I think obviously the RBI carries moral hazard, you know, in terms of, you know, trying to help out a specific or a set of NBFCs. I do believe that, you know, perhaps one way to fix the NBFC issue to some degree, one is RBI has also already ensured that liquidity will remain in surplus. I think that's a great beginning. And the second is, I think we need to get the demand impulses stimulated in the economy, get more people to buy houses and cars and such like. And I think you've got to address the NBFC issue, you know, from that side as well.
Okay.
It will take time, but I think the first step to ensure that liquidity in the system is going to be in surplus. You know, that card has already been played by the RBI. I think I'd like to see more, you know, from the government to ensure that you know, they are indeed focused on growth. And I think that if we can get that going, I think we will slowly but surely, you know, fix the NBFC
Absolutely.
issues.
Even if they pay their bills on time, I think a lot of MSMEs and such like will be helped, and that will indirectly help the NBFCs as well. Out of time, Prasanna, Rajiv Anand, Arijit Basu, Pranjul Bhandari, thank you very much for joining me.